Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host Sandeep Rao. Today, I want to talk about a concept from the world of intraday trading which is as fundamental and as basic as it can get. It's called opening range breakouts. If intraday trading was a language, ORB is a bit like alphabets. That is how fundamental it is. I have seen when traders talk about finding alpha in short-term or intraday markets, they often jump straight to indicators. But before any of that, there is a far more basic question to answer. How does price behave on an intraday time frame? Opening range breakouts are one of the earliest and the most widely studied systematic ways to explore that question. In this episode and in the parts that follow, we'll break this concept down from ground up. We'll look at what an opening range really represents, where the idea comes from, and most importantly, how and whether this actually works in the Indian markets. The idea is to understand this core building block of intraday trading, one that every serious short-term trader should study before moving on to anything complex. So without further ado, let's get started. Like I always do, let me start with the most fundamental question. What exactly is an opening range breakout or ORB? An opening range breakout is an intraday trading strategy where a predefined price range is established early in the trading session using a clear rules-based logic. Once this range is formed, two levels are identified, an upper boundary and a lower boundary. If price breaks and closes above the upper level, a long trade is taken. If price breaks and closes below the lower level, a short trade is taken. In both cases, the stop loss is placed at the opposite end of the range. Typically, only one trade is taken per day. Let me explain with an example. Let's assume Nifty opens at 25,500 at 9:15 am. We decide to use a time-based opening range of 1 hour, meaning we ignore what happens until 10:15 am and let the market form its initial range. At 10:15, we note the high and the low of the session so far. Suppose the price has moved within a 60-point range with a high of 25,540 and a low of 25,480. From this point onwards, if the price closes above 25,540, we enter a long trade with a stop loss at 25,480. And if the price closes below 25,480, we enter a short trade with a stop loss at 25,540. The core assumption behind the trade is that a decisive move beyond the opening range signals some sort of a directional intent, and that momentum is likely to continue for the rest of the day. In that sense, from a trade archetype perspective, this falls under the trend following style, though just on an intraday time frame. Talking about the origins of this strategy, it actually goes back to the days when trading happened in the pits. One person who helped popularize it among systematic traders is Toby Crabel, a hedge fund manager and a former floor trader. The story goes that when Crabel was trading on the exchange floors, he paid virtually no commissions. That gave him the freedom to trade intraday without worrying about costs. And more importantly, it forced him to learn how to take profits quickly. That early exposure is where his bias towards short-term intraday price behavior really took shape. He later captured many of these ideas in his now classic book, Day Trading with Short-Term Price Patterns, where concepts like the opening range breakout were laid out in a systematic, rule-based manner. All of this long before algorithmic and rules-based trading became mainstream. Crabel's journey gets even more interesting after his time on the floor. After nearly a decade in the pits, he went on to work with another legend, Victor Niederhofer, as a researcher and trader. The combination of Crabel's systematic instincts and Niederhofer's deep quantitative and market experience proved to be a powerful learning ground. Years later, Crabel went on to found Crabel Capital Management, a firm that continues to specialize in short time frame systematic strategies with average holding periods typically under a day. Outside of markets, Crabel is also a former professional tennis player and a long-time admirer of Ayn Rand. Two influences that clearly show up in his emphasis on discipline, individual responsibility, and long-term mastery. I'd love to have a conversation with him someday. Let's see if that ever happens. But as with most enduring trading ideas, the opening range breakout wasn't shaped by just one person. Several traders contributed to its evolution in different ways. Most notably, Linda Raschke, Larry Connors, Mark Fisher, and Perry J. Kaufman. Each of them approached the idea from a slightly different angle, some discretionary, some quantitative, some rooted in floor trading, and others in systematic research. But the core principle remained the same. That is to identify clear intraday reference points and use them to define when to go long or short, with risk tightly controlled through predefined stop losses. At its heart, ORB is about market structure, letting the market reveal direction after the open and then responding to it with rules. Now that we have a reasonable understanding of what an ORB is, let's test it out on our favorite index, NIFTY. The hypothesis is simple and straightforward. We define a time-based opening range from 9:15 to 10:15 using 3-minute candlestick chart. If price closes above the range high after 10:15, we enter a long position, with a stop loss placed at the low of the range. If price closes below the range, we go short, with a stop loss at the high of the range. But we take this a step further. Instead of using just one opening range, we construct multiple reference windows, starting with 9:15 to 10:15 and then extending to 9:15 to 11:15 and continuing this process all the way up to 9:15 to 14:15. The objective is to understand whether the timing of the breakout influences the final outcome. We also split the results into long and short trades to check if the data shows any directional bias. The backtest period considered is from January 2019 to present, that is Feb 2026. Before I share the backtest, here's a disclaimer. This is not a recommendation to invest or trade, nor should any of the instruments mentioned be considered for future investments. Trading involves significant risk and can result in a complete loss of capital. The backtest presented does not account for transaction costs, brokerage, taxes, or slippage. Its sole purpose is to illustrate how opening range breakout as a concept works in practice. It's not about evaluating it for its profitability. With the disclaimers out of our way, let's get started. What you're looking at right now are the equity curves for different ORB windows. Right at the top in orange is the 9:15 to 11:15 opening range breakout. Next in blue is the 9:15 to 10:15 breakout, and so on. It includes both long and short trades. Do you notice something? 11:15 as a breakout window consistently outperforms other time windows, 10:15 being the next best. Let's now look at the other performance metrics. Even if we look at the return to max drawdown ratio, the 11:15 and 10:15 breakout windows seem better than the rest. In other words, it's important to catch the breakouts in the first half of the day. That's when we are able to capture those trend days. Now let's break the trades into long and short and see if there are any specific patterns that we see based on the direction of the breakouts. What you see on the chart right now is the equity curves of the long trades only. Again, 11:15 stands out compared to others and 10:15 seems second, but at considerable distance from 11:15. Interestingly, on the long side, the win rates are close to 60%, which is good. But here's the thing, look at the returns to max drawdown for 12:15. Way better than any other time window. Why is that? If you have any guesses, let me know in the comments. Now let's move to the short side and see what's cooking over there. Now what you're seeing on the screen is the equity curve for the short side trades only. Notice that compared to the long side, the 10:15 and the 11:15 equity curves track each other very closely, except for a divergence during the period between 2022 and 2024. Now, if you look at the performance table alongside it, the 11:15 window clearly outperforms across most parameters for the short trades. At the same time, the win rates for shorts hover around 50% mark, which is noticeably lower than the roughly 60% win rate observed on the long side. So what does this tell us? The markets tend to move up more often even intraday? I'll let you draw that conclusion. In summary, it does appear that there is some edge here. However, turning this into a fully developed trading strategy would require a lot more work. First, you would want to check for the day of the week effects. There is no reason to assume this needs to be traded every single day. Next, given the current tax structure, especially the increase in STT, options become a far more practical instrument to explore. But that opens up additional design issues. Whether to trade via synthetic positions, spreads, or outright long or short options, each approach would need to be tested carefully to see whether the strategy remains viable after costs. Options also introduce another critical variable, DT, which is days to expiry, which can materially influence outcomes and must be studied independently. For example, if you choose to trade naked options via a directional view, that is short P to go long and short C to go short, different days to expiry will have different impact on the results, irrespective of how the market moves. Trading naked short options gives you theta advantage, but closer to expiry, it also exposes you to significant gamma risk. Either way, the key point is this. What I've shared here should be treated strictly as a starting point for further research, not as a ready-to-trade system. So that brings us to the end of episode 1 on opening range breakout. In this episode, we looked at what opening range is, where the idea originated, and the traders who helped shape and popularize it over time. We also tested a variation of the concept on NIFTY to see how it behaves in the real world. That brings us to the end of this introductory episode on opening range breakouts. In the subsequent parts, we'll explore additional ways to define intraday reference points and build breakout strategies around them. I hope you found this episode useful and interesting. Do share your questions, thoughts, and feedback in the comments. I'll do my best to respond. Thank you for watching and see you in the next one.